Start. Hey, all right. Whole life insurance. That's what we're going to talk about here today, my friends, here at the Heritage Wealth Planning YouTube channel. I appreciate you jumping on board. I think whole life insurance is not understood very well. B, it gets a very bad rap, actually. And C, it ain't cheap. So I just want to start off with that thing real quick. Whole life insurance is not cheap. I do think a lot of people misunderstand what whole life insurance is, and we're going to dive into that, and we're going to dive into premiums and whatnot. And I'm going to show you how you can actually look at it in a different way that might shed some light on the mechanisms of whole life insurance. Because when it comes to life insurance, literally nothing could be simpler than whole life. I don't understand why people make it confusing. It's not. It's very simple. So first, don't forget to subscribe. As you can see, I got my new subscribe shirt on, so definitely do that. Don't forget to subscribe. This is my 200th video. So 200th video, yay. I can't believe it. I like it. So hopefully I'll be doing these live ones on a probably maybe even a daily basis. I enjoy it. So don't forget to subscribe. And if you do subscribe, hit the notification bell because that way you'll be notified for future content. Like I said, I try to do one a day. Shoot, I'm going to start doing 1 or 2 a day. I got 20 years of financial experience in this big old hard mug of mine. And when you're working for the man in a big cubicle-like company, you can't say what you got to say. You got to do what they tell you to do. And so all these years of experience have been just kind of sitting there, and I've been able to do some stuff that, because I know a little bit what I'm doing, I like to think. But when I separated from my company and started my own firm, I said, I got to just say this stuff, else I'm going to explode. So I got lots of 20 years of stuff to talk about. So right now we're going to talk about whole life insurance. I got my trusty calculator. All right. So whole life insurance, what is it? It is literally life insurance that covers you for your whole life. Crazy to think, right? Your whole life. And the reason why it covers for your whole life is because, as same with term, whole life is a unilateral contract. I pay a certain premium each and every month. There's a level premium. Won't go up, won't go down. It's level. It's contractually obligated by the insurer to me. I don't have to be the insured, but the owner of the contract, as I'm responsible for paying the premiums. And when I have that contractual obligation, as long as I make good on my side, they have to make good on theirs, the insurance company. Now, like term, because term after a term, a certain 10, 20, whatever year term goes away, or it doesn't actually go away, it increases dramatically in the premiums. With whole life, it is fixed for your whole life. And so they're going to do an actuarial table. They're going to say, I'm a 48-year-old man. I don't smoke. I don't drink. I'm in moderately to good shape. So we think you're going to live until you're 93 years old, something like that. I mean, insurance companies have this down to a science, my friends, with all the actuaries they've got on their staff, all the knowledge they have from the previous insured. They know exactly what to charge you. So they say, Josh, we're going to charge you $200 a month for a $250,000 policy. And I'm just pulling out of the air. I have no idea what it'd be. We're going to charge you X for X or Y. And that's as simple. So as long as you make these premiums every month, you make those premiums, it doesn't matter unless you live to 120. It doesn't matter if you die tomorrow. We will pay your heirs, your spouse, or your estate. And hopefully you don't make your estate the beneficiary of your life insurance. For the love of me, don't do that. Make it a human being. But we're going to leave your heirs X amount of dollars for life insurance. It's literally that simple. It could not be any simpler. I don't know why. I was just reading an article before I got on here. This guy was like, it's so complex. No, it's not. You pay $50 a month, you get a certain amount of life insurance. If you die at a certain amount of time, you get X amount of dollars cash value. It's literally that simple. It could not be simpler. It's a hell of a lot simpler than term, that's for sure. Now, we're not talking universal life. Please understand. You have 3 mechanisms of life insurance. You have term, which is renting. You don't have any equity built up in it. It's cheap on the front end because it gets a hell of a lot more expensive on the back. That's why term is so cheap on the front end, because as you get older, it just is incomprehensible how expensive that is. But you don't build any cash value. There's no equity. It just covers you for an unfortunate event, which is really true insurance, frankly. But that's term. Then you got permanent. So you got term, temporary, renting. Then you got permanent, like buying a home. So you got cash value insurance. There are 2 types of cash value insurance. One is whole life, the simplest type of life insurance, going back to dawn of mankind. This is how we insure people. The other is universal life. And then you got variable universal life, index universal life. I don't like those at all, but I'll get into that next time. But right now I just want to focus on whole life, the one little sliver of the insurance market that we're discussing. And that's whole life. Do not make the mistake of thinking whole life and universal life are the same. They're not the same, my friends. They are absolutely not the same. They're just not. There's no such thing as universal whole life, by the way. I was watching a guy trying to advocate on the infinite banking thing. And oh gosh, there's no such thing as universal whole life. There is whole life or there's universal life. That's it. And then you got term over here. All right. So here's one of the issues I find that I think people overlook about whole life. The article I was reading from Wealthfront, it actually ticked me off because Wealthfront, I think, is a pretty good firm on the investment side. But they gave this quote on for the whole life versus the term, and he didn't even say the death benefit. I'm like, so he had this whole thing about whole life is bad as an investment. And I agree with that, actually. For an investment, you're not investing in whole life as an investment, but he didn't say what the death benefit was. And everything is contingent on the death benefit. How much are you going to leave to your heirs when you die? I mean, if you don't know that, what's the point? We got to know what your death benefit is going to be. So I just ran a couple numbers for you here. And I just said, okay, I'm going to take my trusty calculator, my nice little notepad. I said, I can get $250,000 a whole life. I'm going to get $250,000 a term. That's all I say, nothing fancy here. And I say, I'm going to say my whole life coverage is $200 a month. And literally, I don't know. Frankly, don't care. Look at it for you. It's all contingent on your underwriting. I don't know. But if I got $200 a month, a whole life, and you got a term for cost you $50 a month, at the end of the day, after 10 years, I'll probably have about $24,000 in cash in there. All right. And that's where whole life comes in. You don't get a lot of cash value on the front end. Usually it takes about 10 years before you get enough cash that actually is about the equivalent of what you put in for premium. All right. So you put in $24,000. That's your cash value after 10 years. Now, if you're using a firm that charges commissions, like the guys just talked about who's using MetLife, they're going to charge 63% of the first year premium as commission to the sales guy. You're not getting, you're losing it. That's all coming from you. It's all coming from your cash value. So when it comes to using a brokered product like MetLife, Northwestern Mutual, any of these big, there's a significant commission there on the front end. There's just no getting around that. So what I'm talking about is a firm like USAA, TIA, CREF, some other mutual companies out there. Off the top of my head, I don't know. But anyway, some of the other mutual companies out there where they don't charge a commission to the broker. All right, there's no salesperson. You're buying it. And so at USAA, for instance, what would happen is you put in $200 a month and you fast forward 10 years and you have roughly $24,000 of cash in there. So you had a $250,000 death benefit. You had $24,000 of cash. That was the amount of money you put in. All right. So essentially, if I have $24,000 of cash and I want to cancel my contract, what did it cost me? I put in $24,000. I'm getting $24,000 out. What did the insurance that $250,000 over those 10 years cost me? Well, it cost me nothing because I put in 24. I'm getting 24 out. Now there is an opportunity cost on that. I missed out on growth potentially of that 24,000 going into the market, whatnot. But in terms of the actual cost to me for that $250,000 of life insurance through the whole life, I actually paid nothing because I had $24,000 I put in. I got $24,000. I canceled it, and I still had that umbrella of $250,000 cover me during those 10 years. Now, what other people say was, well, yeah, if you did term though, and you're only putting $50 a month in, and I had an 8% a year growth after 10 years, I had $27,444 in there. Well, that's true. Absolutely. After 10 years, you had $27,444. I only had $24,000 in there. That's 100% correct. You got $3,444 of cash more than I did. All right. There's no getting around that. Two things though. What if you only got 6% rate? What if you didn't get 8? What if you only got 6? Then you only had $24,588. All right. So your 6% rate versus my just no rate essentially is you only had $24,588 in there and I had $24,000 in there. And the reason for that is simple because you're only putting in $150 a month. So you're starting at such a small amount. You're not really accumulating much in terms of until you get to the 8th and 9th and 10th year, because $150 a month doesn't, 10% growth on $150 a month is only $15. So you're not making much money until there's a significant cash value bucket in which the growth can really compound for you. Exactly. So what happens now? So your 6% or 8% has a little bit more cash value than mine. Absolutely. Mine's 100% guaranteed. Yours is not. Yours is not 100% guaranteed. So let's just say we had a market that was down 30%. All right. So now you're 27,444. Again, you had 3,000 more than I did after 10 years is worth how much? Is worth 19,000. And see, this is where people overlook the whole life insurance versus the term by term versus invest the rest. They say, oh, if I can get 8% a year, you're making the typical mistake is the markets don't give you linear returns. I did a thing on Vanguard where they showed you the average is 10% roughly, but the year over year returns are nowhere near the average. All right. So if the average is 10, it's between 8 and 12%. There's only like 15% of the time is even between 8 and 12%. So if the average is 10 and you're banking on 10, you're looking at sometimes 15%, sometimes negative 15%, and everything in between. Very rarely do you even get within 8 to 12% when the average is 10. And that's what I think a lot of people miss. In fact, I know they miss that for a fact. And they certainly miss on retirement planning because they don't realize the difference between variable rates of return, which average a certain amount over time, and fixed rates of return, which give you a fixed rate. And that's what whole life insurance does. It gives you a guaranteed, contractually obligated fixed rate of return that you know for sure it will be there as long as the insurance company doesn't go bankrupt. Your buy term and invest the rest does not give you that. Dave Ramsey is not giving you 12% each and every year. It doesn't happen. Could you average 12%? Sure. What if you got on the first part of it, though, and you got on the back end, you got hammered? You're still averaging 12%, but you have less money than what you put in because the front end of it, when you had no money in there, did great. The back end, when you had all your money in there, got hammered. And the average is still 12% rate of return. But for you, all that matters is the cash value. And the cash value has dropped significantly because you had a bad market. And that's where I think whole life gets a bad rap. They're comparing a fixed guaranteed income account, a bond, essentially. Whole life is essentially a bond. You're roughly going to get the yield of a 10-year treasury to a variable equity type of account. And then the guy at Wealthfront, he was comparing it to, he had a 7.12% rate of return, net of fees and all that. But part of his return is based on his ability to generate cash alpha or tax alpha. Tax alpha just means he's able to manipulate the tax code to generate an extra 1.5% a year on your returns. I mean, you can't do that. You can't say we're going to get you an extra 1.5% more income each and every year because we're so good at taxes. That's just bad. Where whole life can't do that. That's the thing. That's why everyone says whole life is bad or is evil or is sold to and all that. They're saying whole life insurance, you're getting sold. No, you don't want to pay a commission to some guy that's a schmuck. I get that. But if you want life insurance and you want to be there and you want a cash value that you know for a fact in 10 years, you're going to have X amount of dollars without any concern whatsoever. There is no, other than the insurance company going bankrupt, there is no risk to this. That's all there is to it. It might not be as much as you would like in the equity market, stock market, but that's the thing. The stock market is based on ifs. Whole life insurance is based on guarantees. And so to compare the two it's silly, actually. I don't get why people do this. The complexity of whole life, there's no complexity there unless you want to make it. The complexity is, well, if you borrow against it, well, yeah, you can do that. I don't know why you would do that with whole life insurance, but you certainly could. If you had a significant cash issue, well, your whole life is there for you to borrow against. I don't like the infinite banking thing where people say, oh, you can make $60,000 a year and you only had to put $20,000 a year for 20 years. That's silly. But yeah, the cash is there for you to borrow against. Absolutely. There is some issues with doing that. I'm not a big fan necessarily. But what I like about whole life at the end of the day is that you know for a fact what's going to be there. Look at the illustration. Look out 10 years. Say, can I afford $200 a month for the next 10 years? The drawback about whole life is because it's more expensive on the front end because it's level. All right. So you have level term, which is level for the term, the 20 years, and that jumps up through the roof. Well, whole life is level for your whole life. So inherently, it's going to be more expensive on the beginning as term, say, is low, then term goes higher. Whole life is just flat. If you can't afford the premium, you're going to have a hard time. That's for sure, because that's what you got to pay to make the contractual obligation. And so that's where term life can look very, very attractive because the premium's so cheap on the front end. But you don't look at insurance as an investment. That's silly. Insurance aren't investment. Insurance, they would cover you if something happens to you. If you got hit by a bus or something like that and you need to have life insurance, so that's what life insurance is there for, which is why I say everyone should get term, because term from a cash flow perspective gives you the best bang for the buck when you most need it, which is usually when you're young and don't have as much cash. That's just a fact. You're not going to get a big bang for your buck on a moderate cash flow with whole life. You're just not. I'm telling you not. I mean, I know a guy who's trying to sell me whole life. He said for $20,000 a year, you can have. I said, dude, I can't afford $200 a month. You're talking $20,000 a year. What are you talking about, man? I was like, come on, let's be realistic here. That's where term gets. I think so. That's why everyone should have term, because when you need the most, when you have a mortgage and you have kids, that's when you need your most life insurance. That's typically when you don't have the best cash flow to afford a pretty sizable whole life. All right, so a couple other things real quick. Whole life is okay for estate planning. All right, so what I mean by that is because of the cash value in their whole life will generate decent cash value ever over time. I mean, there's no getting around that. You're not hitting home runs here. You're going to hit singles and doubles. But singles every, maybe a couple walks, but singles every at bat is not a bad place to be. But you're never going to get a grand slam. You're never going to wake up and say that's the best investment you ever made. Never going to happen. So whole life, what happens is the cash value builds slow but steady, guaranteed over years and years and years and years. The problem is, unless you're trying to do something, for estate planning, i.e., I want to leave a legacy or something like that, you don't really care. You don't care. The cash value in a life insurance policy doesn't do you any good, because of the whole life, you don't get the cash value. Your heirs don't. They get the death benefit. And so what happens is if you have $1 million death benefit, $100,000 cash value, that would inherently mean you have a $900,000 life insurance component. So you die, the kids get $1 million, of which $100,000 is yours. All right. So that's the cost of the life insurance is the $900,000. Now you're 94 years old, you got $1 million death benefit, but you got $895,000 of cash in there. You die, your kids still get $1 million. That $895,000 is your money that's going back to them. And so you only had a life insurance component of $105,000. At the end of the day, that's not a good use of your estate planning. It's just not, because you're saying to yourself, I'm paying a pretty significant amount of cost of insurance for this little threshold of insurance, but I could have had that cash money and done something else with. And that's where I don't like whole life for establishing an estate, leaving it to the church or something like that, establishing a legacy. Not a fan of that at all, simply because of, like I just said, what happens is corridor, the cash value starts going up and up and up, the death benefit stays flat. Now, there are different kinds of whole life where they can have dividends and payments and stuff like that, and that's fine, and that's actually pretty good. But at the end of the day, just remember, if your death benefit is flat and your cash value is going up, that means there's less and less and less in life insurance that you're paying for, and more cash value. So when you get hit by the proverbial bus, the life insurance company is paying less to your heirs in insurance and paying more to your heirs in your own money. And that's why you don't really like to use whole life for an estate planning purpose, because that's your whole money. You could have used that yourself and done other things with it. So that's whole life insurance. I don't know why it gets a bad rap. If you're going to buy it, generally speaking, I recommend you buy it through a mutual company that doesn't have a big front end commission. But every firm, the TIA, Craft USA, they all charge 5% front end load. So if you put $10,000 in there, they're going to charge you $500 right out of the gate, even though there's no salesman getting a commission off you. There just is not. So you're still going to pay a load, but you're not going to pay a commission to a salesman. And the drawback, like with MetLife, when I was using that example, is he was showing the lack of cash value after 10 years. Well, yeah, because again, a significant portion of your money went to the sales guy. If you get a mutual company that doesn't have salespeople, that just is like USA or TIA or whatever, that all that money comes back to you. And so what will happen is you'll see after 10 years, your contributions will probably equal your cash value roughly after 10 years, which means, again, if you were to cancel the policy, you would get all your money back. You wouldn't pay tax on it. You wouldn't have made any money, but you would have got all your money back, guaranteed. And that's not too shabby. You cannot say that in a buy term and invest the rest. You don't know what that money will be worth. It might be worth more, it might be worth less. You just don't know. And that's the drawback. And so at least with whole life insurance, you know for a fact what it's going to cost. It'll never change how much the death benefit is and what the cash value will be in a certain amount of time. All right, my friends, hope you like this. Hope this helps. If you like what you see, don't forget to subscribe. Go to the YouTube, the blog, heritagewealthplanning.com. I got a lot of good interviews lined up for my podcast, the Josh Scanlon podcast, by the way. I'm stoked, man. We got lots of good stuff. So looking forward to that. Hit the notification bell down there. Thumbs up always help. Thumbs up for sure. And if you have any comments, put them down below. Love to hear you. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.